The first trading day of 2022, January 3rd, seemed to be no different from the previous days in the stock market upswing that started while Barack Obama was still in office. The S&P 500 reached a new peak. The stock of Tesla, the firm that revolutionized the auto industry and made many investors wealthy, increased 13.5%, almost reaching its all-time high. How does that compare to the beginning of this year? Stay tuned. Welcome to Money Talk Sundays. I'm your host, Stevie B. For those tuning in via your favorite streaming platform, hit that like and share button. You can also subscribe to the Money Talk Sundays podcast. The link will be in the description box right there. For those viewing on YouTube, like, share, subscribe. Like, share, subscribe. Again, like, share, and most importantly, subscribe to your boy. Come on. I'm trying to get these numbers up. You can even hit that notification bell to receive the alerts of new videos dropping as they drop. Now, back to 2022 and 2023 and how they compare. Because stocks have had their worst year yet since 2008. Since 2008. And this is ridiculous. Very ridiculous. Because last year was the year the long stock market rally ended. It just stopped. Okay? So that Monday, it turned out, marked the end of a market that had gone primarily in one direction for more than 10 years, with the S&P 500 gaining by more than 600% since March of 2009. Just 2 days later, the Federal Reserve released the minutes from its previous meeting, a common occurrence on Wall Street. These minutes showed that the central bank's decision makers were so concerned about inflation that they considered possibly needing to speed up the interest rate increases. The S&P 500 fell 1.9% as a result of that release and how severely investors reacted. And that ensued was a market sell-off that started later in the year and set the tone for the remainder of 2022. Market has been selling off all of 2022. I guess we're going to get some kind of bounce back and buyback this year. We shall see. Financial markets have seen a generational transition in the past year as a result of the Fed's repeated interest rate increases in an effort to stem the worst inflation in decades. Its efforts are starting to bear fruit. The rate of price growth has recently slowed down. But at what cost? What cost, I ask? The Fed's dramatic measures to slow the largest economy in the world have had far-reaching effects. The year marked the conclusion of a period of low interest rates that made borrowing affordable and encourage investors to take risks in search of rich returns on the stocks of emerging tech companies, cryptocurrencies, and debt markets. Both the S&P 500 and Tesla have fallen from the heights they hit on January 3rd, 2022. The S&P 500 had a worse finish on Friday and down 19.4% for the year, which was its worst annual performance since 2008. Since the collapse of cryptocurrency behemoths like FTX, debt has become more expensive. However, the Federal Reserve has stated that its work is far from over, far from done, even as the American economy appears to be headed for a probable recession. Even while inflation is beginning to decline, it is still far too high, and future increases in interest rates portend more suffering. Better buckle up your seatbelts, strap up your bootstraps, because we're in for a long ride, ladies and gentlemen. Because as a result of inflation, central banks driven markets this year, and that will continue into 2023, according to Christina Hooper, Chief Global Market Strategist at Invesco. This is a period in history that is extremely, very dramatic. A series of amazing events that began with the epidemic have all been witnessed by us. Now, the problem facing the Fed only grew more difficult in late February when Russia's invasion of Ukraine pushed food and energy prices skyrocketing, sparking a crisis in less developed nations that rely on the importation of grain and oil. The Fed started raising interest rates in March. The main instrument used by central banks to fight inflation is higher interest rates. In theory, rising borrowing costs and slower economic demand caused by rising rates should restrain price increases. The 10-year U.S. government bond yield, which sets borrowing costs around the world, has increased by 2.36 percentage points this year, the most since records began in 1962. And as a result, interest rates on debt such as corporate bonds, mortgages, and other types of debt has increased. Now, reduced profits for businesses also result in lower stock value. For tech companies whose expansion had been aided by low loan rates, this proved to be especially true. Full of tech stocks, the NASDAQ Composite Index has decreased 33.1% in 2022. The air left other more speculative markets as well, as investors lost money in the stock market and people faced soaring inflationary expenses. One of the most well-known cryptocurrencies, Bitcoin, the granddaddy of crypto, Bitcoin, saw its price fall, and so-called meme stocks like GameStop and AMC Entertainment that Wall Street bets was all crazy about, whose share prices rose during the pandemic thanks to a new breed of amateur investors, saw their prices fall throughout the year. The value of Tesla, Big Daddy Tesla, Mr. Elon, a stock that is well liked by the same group of investors, has fallen by 65% this year, the worst performance the firm has had since going public in 2010, and the second year in a row that the stock has deteriorated. Now, mind you, we know Elon has contributed to the deterioration by purchasing Twitter and acting a fool with Twitter. We understand that. But while emerging nations like Sri Lanka and Pakistan struggle and Europe is dealing with an energy crisis, the U.S. economy has held up despite growing prices. Investors were able to put their money in the United States because of its relative strength, and the influx of funds helped raise the value of the dollar. This is the transfer of wealth. They're putting their money back into the U.S. dollar, increasing the value of the dollar. The dollar outperformed the euro for the first time in 20 years. Now, just days before the central bank was scheduled to convene on June 15th, and unexpectedly grim data showing a collapse of consumer sentiment alarmed officials and helped propel the S&P 500 into a bear market, which is defined as a fall of at least 20% from its most recent top, in this case, January 3rd. The Fed was preparing for another rate hike, projected to be 0.5 percentage points after raising interest rates twice by a total of 0.75 percentage points, which was the amount it predicted would be required for the entire year in December 2021. Instead, for the first time in close to 3 decades, the central bank increased rates by 0.75 percentage points, highlighting the dangers the Fed associated with growing inflation. Nevertheless, the upheaval caused some investors to believe that the worst was gone. Psych! The stock market increased in July as corporate financial results started to come in looking better than anticipated. Mid-June to mid-August saw a 17.4% increase in the S&P 500. Rising stock prices were problematic for the Fed, however, because they enriched investors while undermining its attempts to reduce inflation. In order for them to reduce inflation, you can't be making more money. You can't be making more money to spend more money. Jerome H. Powell, the head of the Fed, sharply reminded investors that the fight against inflation was not done, and that interest rates would need to climb significantly before the central bank would complete its campaign at a closely watched economic symposium in Wyoming. The S&P 500 reached a fresh low in October when stock markets started to decline again. The Fed ain't playing. We're going to shut this market down if we got to. Investors are bracing themselves for a confrontation with the Fed in 2023. Now, the S&P 500 has increased by roughly 8% from its low, despite vibrations caused by a huge swing in the value of British government debt in September and the subsequent collapse of the cryptocurrency markets through November. The Federal Reserve raised interest rates in December to a target range of 4.25 and 4.5%, which was far higher than anticipated at the beginning of the year. The amount of interest rate growth needed in 2023 was also increased by policymakers, but markets haven't batted an eye. There are indications that inflation is slowing, and some predict that the central bank may halt rate hikes sooner than expected to allow the economy to adjust to the consequences of the higher interest rates that are now in play. Don't sleep on that. Todd Sandoz, co-head of equities for the Americas at Barclays, said, "I think the equity market right now is a bit glass half full and is not totally pricing in what the Fed and other assets are telling us. Corporate profits, which some investors anticipate to be dramatically revised lower in early 2023 as persistent inflation and high interest rates start to eat into earnings, are another source of risk. That might indicate that stocks still have more to drop. Expect it to drop. Wait for it to drop. It will drop." The bank experts who predicted where stocks and bonds will end in 2022 were fairly upbeat a year ago. It was all good just a year ago. Even the most bearish prognosis for the S&P 500 at the time, published by Mike Wilson of Morgan Stanley, believed the index would end the year 10% higher than where it actually would, according to a Bloomberg compilation of forecasts. Now, Hugo St. Marie at Scotiabank, the most upbeat strategist this year, doesn't even expect the S&P 500 to make up that lost ground in 2023, while the majority anticipates the market to conclude roughly where it started after a fall early in the year. According to Doug Porter, chief economist at BMO Financial Group, given what has transpired over the past 12 months, we all have to be prepared for a large surprise again. Whether it comes from inflation or Fed policy, we must exercise courage in considering the possibilities. Ladies and gents, 2023 is not going to be the bull run that you imagine it to be. 2023 is not going to be the bull run that it was in 2020, 2021. 2023 will be a slow climb back up the ladder. Why? The Fed is intent on killing inflation. And if you're out here continue to make large amounts of money in the stock market when you shouldn't be, they're going to stop that. They're going to slow it down because we need to kill inflation. We need to kill inflation. And granted, while the lower class and the middle class are not as flexible in the stock market and the crypto industry, they still make up a large proportion of the economy. And if they are not slowed down, and you retail investors and your investment firms are not slowed down, inflation will continue. Why? Because of all that excess capital that was flooded into the market. Anyway, 2022 to 2023, expect much of the same. Expect a lot more of the same. That's all we can say for 2023. It's going to be a slow grind, slow building. 2023 is the year of consolidation, ladies and gentlemen. It is the year of consolidation. You heard it now. You heard it on January 2nd, 2023. 2023 is the year of consolidation. Thank you for tuning in to Money Talk Sundays. I'm your host, Stevie B. Thank you for tuning in. Happy trading. Happy New Year. And God willing, I hope some major event can be a catalyst to another huge run this year. But as of right now, the way things are going, the chips are set up where it's not going to be a huge bull run this year. The odds are against it. So we just got to bide our time, take our pieces bit by bit, and keep it moving. I'm your host, Stevie B, signing off on Money Talk Sundays. Happy trading, ladies and gentlemen.